I'm Josh Sigman, and I'm a mortgage lender. I'm also a geek for money, not just earning it and saving it, but literally everything about it. I love that money has rules. It has its truths. I love investment strategies, and I love making money work for us. For so many, money is emotional. For me, it's logical, like a puzzle. My passion is also helping others with their money. I love looking at people's finances, dissecting their puzzle, and rebuilding with strategy and purpose, and I'm really good at it. I'm making this podcast about my money strategies, not the things that are written in books or sold in programs. It's a podcast outlining the lessons I've learned and used for the past 15 years. These strategies help me and those who use them save more, give more, create wealth, and retire early. Let me teach you how to build your net worth. You ready? Welcome to Sigman Sense.
Sometimes I tend to slouch. I start slouching. So it's a reminder.
Did you see that?
My what?
Your droopy eye.
Okay, you can't mess around with that because I am starting to. My eye is.
You have a droopy eye.
Stop it! Stop it! Stop it! I really am
You're
starting
in your 30s
to droop.
now. It's okay. It's gonna
like
happen.
no, it's a thing,
I know.
and I'm very self-conscious about it, which means you cannot make fun of me for it. That's how that works.
Oh, I was just stating fact. I wasn't making fun of you.
It is a thing. Like, I mean, and it's real bad in the morning. I mean, so I have to get some Botox or like tape. Maybe some tape.
Commonly asked questions. So I can kind of give you some, one is, what should people focus on? So you can write your own words. This is just for me to think about, but I would say the most common asked questions are, when do you know it makes sense, right? Like when should it make sense? One
thing I did have written in the notes is try to keep your first house as an investment property.
Well, we're talking about refis, not investment properties.
I said that out loud and it didn't make sense.
Yeah, that was part of when we were doing an investment property one. This is not investment properties, this is right?
I have when and why and how to refinance.
Yep. So the other one you're thinking of is a separate thing on buying investment properties. Okay, I'm ready to roll.
Let's do it.
We have about an hour and 15 minutes.
When was the last time you refinanced someone?
About a half hour ago.
Half hour ago. Well, good. Then it's top of mind.
All right. No, I'm not good. I'm good.
Energy.
You got a pop in the face today, man. Wasn't expecting something.
That's what you get for back talk, brother.
Where's that volume button?
Who popped ya? Who popped ya?
Oh, it won't make your mouth stop working.
Haha. Like you got some negative information?
Mm-hmm.
That's not good. Client, partner.
Nope. Team related.
Mm-hmm. Oh, lovely. So that means my pop is coming as soon as we go off air.
Probably not.
Oh, all right.
Okay, you got that. We're good there. You don't care if my phone's on here?
I don't think
I
so.
do.
Okay.
The water bottle is okay.
By the way, have you seen how beautiful these are? I mean, does it make you feel like you've arrived in life?
I paid somebody to put this together? No.
No?
Let's do this.
Well, then you're... Yeah, lower that bar.
La, 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 la.
Learn to appreciate the little things.
A-E-I-O-U.
Stretch out.
Okay, here we go. Hello and welcome to another set of Sigman Sense. And today we're going to talk about something that obviously I deal with on a daily basis in mortgages, which is refinancing. It is definitely part of the money talk because there's always questions about how, when, why you should or shouldn't refinance. What are the commonly asked questions? What are some pitfalls I see clients doing all the time? There is some predatory lending I see when it comes to refinancing. Unfortunately, I see that all too often.
Yeah.
But there's obviously a very healthy reason to refinance when it makes sense. And so I want to kind of walk through that. I didn't know if you had any specific questions to start with, or if you want me to just roll with it. And
No,
we'll
I think we need to talk about what the heck a refinance is anyway. Are you okay?
Turn off the phone.
knocking
my head.
knocking things around.
There we go. Okay, we're good.
Yeah, what is a refinance?
So a refinance in general is just whether it has to do with the rate or term or cash out. What you're doing is you're redoing your mortgage. The easiest way to explain it to the general public is a redo, right? So let's just say that you might have started a mortgage and you already have one in your home, 3 years old, and so you've been paying in for 36 months into a 30-year mortgage, which is a 360-month mortgage, and you're 36 months in. Okay. Well, you might have locked in a rate of 5%. You know, if you go back a couple of years, rates were over 5%. And obviously now rates are under 4%. They're in the threes with better credit scores. There's always, you know, depending on credit, we've talked about this before, depending on your credit and loan to value and the timing, obviously could be different. But in that example, you're talking about a 2-point difference in interest rate, right? Well, we're not talking about carrying a $5,000 credit card balance. We're talking about a $200,000, $300,000, $400,000 loan amount. So rate does matter, right? So there's when you're doing this redo in this example, when you're dealing with what's called a rate term refinance, all you're doing is re-amortizing your loan back to a 30-year or changing the term to shorten it to a 20-year or 15-year with whatever the new rates are. So in this case, dropping a rate from a 5.25 to 3.5 or whatever it is, with the new lower loan balance because you've been paying on it for 3 years.
Right. And
what most people will do if the appraisal permits, because there's typically some appreciation. So what most people do is roll the closing costs themselves back in the loan itself and then restart the mortgage over.
Restart it. Okay.
Right. So, it's kind of interesting. People can save hundreds of dollars a month in their monthly payment, which is a car payment, right? So, and that's one of several reasons why to refinance. But in general, the way to think of it is you're redoing your mortgage. You're starting over from scratch.
Okay. So you're redoing your mortgage. And so one reason to do that is to lower your rate, which
is more specifically to decrease your payment. So I would say the majority of refinances are specifically to reduce the payment, right? We're unfortunately a debtor nation. We have more debt than we have savings as a whole. And it's been a couple great years of heyday and people are out spending what they're making. And so all of a sudden debt adds up and now we feel the pinch of $100 difference of cash flow or $200 difference of cash flow makes all the difference in the world for the average American. And so decreasing the mortgage fixed payment helps out. Now, another reason why that happens is one thing that is not fixed, even in a fixed rate mortgage. So separate of an adjustable rate mortgage, what's not fixed is property taxes and insurance tend to go up over time. Right.
Okay. Yeah.
So even if somebody started with a payment that they felt comfortable with and they could afford, somebody might have had a budget of $2,000 and they bought this house. And by the time they did everything, they ended up with a monthly payment of $1,950. So they feel great. And we do know that salaries don't change as fast as properties appreciate.
Yeah.
And so, but maybe the property tax is raised over $100,000 of appreciation, which is great in theory, right? Because you've got a great investment going. But it also comes with a consequence of an extra, depending where you live in Texas, about a $2,500 additional tax burden,
right?
Which is $200 a month. So now what was a $1,950 payment now is a $1,150 payment. $2,150 payment.
Yeah.
And that could be the difference of feeling comfortable versus feeling pinched, feeling house poor.
Okay.
And so the most common reason to refinance is to decrease the monthly payment.
So what about if you are not in a position where you need the extra money or, that $100 or $200 per month is a big deal. Is it still reasonable to consider refinancing to lower your payment?
Sure. So there's certainly lots of reasons to do it. I'll just go through at the top level, the top 4 reasons, right? Okay. So dropping the monthly payment would be the primary. The second one, though, is decreasing the term. So the term being, if you're doing a 30-year mortgage, dropping it to a 20-year mortgage or a 15-year mortgage or a 10-year mortgage, right? Why would somebody do that? Well, first of all, their payment's going to go up. So exactly what you're saying. They don't need the payment to go down.
Yeah.
They're okay with payment going up because their specific financial goals might be to pay it off by retirement,
faster.
right?
Yep.
Pay it off faster. And so that'd be an example of the payment going up. A third reason why people tend to refinance is to take cash out. So reallocation of debt, you've got to do, some people do cash out refinances. In fact, a ton of people this year are doing cash out refinances. In fact, 30 minutes ago, I left my office and I did one. But the idea being that, maybe somebody has $15,000 of credit card debt, a $10,000 car payment for their kid that they bought their car for when they're 18 or 16. They've got a couple little Best Buy and Victoria's Secret credit cards that are a couple $1,000 here and there.
Yeah.
But all of them add up to a couple hundred, $500, $700 a month of debt. Well, what's crazy, what the theory is financially is that anytime you can trade a short-term, non-tax deductible, high interest debt for a long-term, low-rate tax deductible debt, the second would make more sense, right? Even if, and I know tax laws change every couple of years, so currently there's not a big advantage to the average consumer with a write-off for mortgage interest anymore. You have to hit a certain threshold anyways of itemizations. But if I can take a 5-year payment that makes me feel uncomfortable and stretch that over 30 years, the payments could go down significantly. Just to give a basic example, for every $10,000 financed in a mortgage on average in my career, it's been about $40 a month.
Yeah,
so if you increase
every 10,000 finance,
it's about a $40 monthly payment difference. So if I raised my mortgage amount by 20 grand, it might cost me, all rates held equal, maybe $80.
Yeah.
Well, what can $20,000 do of other debt? A $10,000 car loan might still have a $350 payment on it. A $10,000 of credit card might be another $350 of minimum payments. So if I'm trading $700 of monthly payment cash flow against $80 of monthly payment cash flow,
right?
Then the mortgage went up. The payment might have gone up by $80,
but
now I've eliminated $600-700 of other debt. And so that's a huge difference. It's always, what do you do with that? Like if you do that and then you choose to spend $700 a month on Vegas, bad choices. But if you take that extra $600 a month that you freed up and start applying that towards savings that you might not have, or finally contributing to your 401k or IRA or SEP.
Oh, I think that's interesting. Talk through that, because there's people that have taken cash out of their house only to put it into an investment vehicle, right?
Yeah, that happens,
And that makes sense. If it
can, and I'm not a financial planner by any means, and so it's worth talking to a professional in that area. But the theory is always that you can borrow for a house, you can't borrow for retirement, right? So this comes up more often when people are purchasing properties than refinancing, in that somebody sold their last house and they netted $100,000, and so the question comes, well, should I put that $100,000 into my next house? And my answer is put down as much money as it takes to make your payment comfortable, but no more than that, because if you take that extra money and apply that towards your retirement and the house appreciates, which over time they tend to, not always, but they tend to appreciate over time, then your net worth is just simply higher at the end of it, right? So, but there's a couple of reasons why to do it, but those are the primary ones. The last one, by the way, fourth most common one is divorce. Or death. Divorce, death, I'd say fall in the same category. And the reason why that comes up is most of the time, not quite often, most of the time in a divorce, if one of the two spouses keeps the property, they have to, within a period of time, award the property and its debts to the other party, right? So we're married, we're not, but we're married. Thank God. For sure.
Although I do come with a microphone that you can turn off.
That I can turn off. Your switch I can flip off and be done with you, right? But my point is that we're married. You decide that you want to keep the house, and I'm still on the mortgage. Well, I don't want to leave it in my name because that's going to possibly prevent me from being able to buy another property in my own debt ratio. Or you could be very vindictive and intentionally miss payments, which will hurt my credit, right? So that stuff needs to be worked out before
divorce. So if you get a divorce, you don't have to come off of the mortgage. You have to actively refinance off of it?
Yeah, the question is that if you do nothing, what happens, right? And the answer is you are at risk. If
And
on
when
both sides,
when you go to purchase a new house, it'll come up and it's
and
counted.
think about the flip side. If you're keeping the property and you live in it for 10 more years, 15 more, you pay off the mortgage, but you never remove me from title. And now the house is appreciated by 50 grand, 100 grand, 500,000. Time to sell. My name is still on the deed. I still own it.
You still own it. So you still are 50% of...
If it's not identified specifically, and that's why for sure divorce attorneys specifically identify separation of assets and debts. But if you just try to do something on the internet and forget that piece, then in theory, at the end, you're like, I've paid off the mortgage on my own and I appreciated $250,000. Great. I'm expecting all the money. But now you have to argue with me because I might just make your life miserable and not sign. Right. Or I might ask you for a check to sign, right? It depends on how amicable divorces are. But those are the things. And death is the same kind of thing, unfortunately. That is death and taxes, right? It's got to happen to all of us.
My second grade teacher taught me that. How weird is that?
Your second grade teacher?
My second grade teacher. Her name was
How long did she teach for? That would make sense if she's been doing it for 25 years.
Her name was Mrs. Ditto. And
Ditto, okay.
I remember vividly her saying, you don't have to do much, but the two things you absolutely have to do is die and pay taxes.
I'm not sure that's mature enough for a second grader.
She
but
also had a rotation of outfits. So she had 2 weeks worth of clothing and Monday, Tuesday, Wednesday, Thursday, Friday, Monday, Tuesday, Wednesday, Thursday, Friday, and then she'd repeat.
OCD much or just smart and frugal?
I don't know, but why I remember those things.
You should reach out to her and check on her.
I should.
You should. But I mean, those are the basic things. But when I was saying about death, depending on how you buy the property, and each state's a little differently as far as community property state or not, but transfer of the debt debt and the deed upon death to the other party, the survivor, quite often is needed. It's not always needed, depending on how the initial mortgage was set up, whether they're both on the deed and both on the note or not. But just for safety, it prevents problems down the road.
Okay,
right?
So there are 4. So we've got rate, to decrease your rate, to change the term. Yep. So go from a 30 to a 20 or a 10 or a 15.
Or the opposite. By the way, somebody gets divorced, they had a 15-year mortgage.
Oh, yeah.
Now they don't feel comfortable with half the income of the family.
Yeah.
They would go back to a 30. Or if they made their decision originally based on the best of times, and then their company slashed and burned salaries and commissions or whatever, and now they need to decrease the term to lower the payment, that's another why you can go reverse, not just to shorten it, but it could be to extend it.
I find refinances so fun. I just think I don't really understand the inner workings of them, but I just feel like it's such a great way that you can get very creative, for lack of better terms, with your asset that you have in your house. There's a lot of things you can do with it. So, okay. So rate, term, cash out, and then, if you're death, divorce, those types of, okay. So those are the 4 reasons.
Yep.
When I bought a house last year. Should I even consider?
That's a good question.
Do I plug my ears and don't want to, because there's a lot of noise?
It's a commonly asked question, which is like, when does it make sense? When should I think about it, right? My first answer is that you should hopefully have an advisor that keeps in touch with you and reaches out occasionally and lets you know what's going on in the market. Because I think we've talked about this, the average consumer doesn't really have a feel or understanding of the market anyways.
Yeah.
So they can miss an opportunity by a matter of 2 weeks, and it could be a huge difference to their family.
And they don't know who to listen to and what's really right.
What's right.
Because there's
why there's a lot of, not necessarily bait and switch, but for sure a lot of predatory lending. The old rule of thumb used to be, if you can save at least 0.5% on your rate and are planning to keep the property for 3 years, it makes sense. Now, that is a generic answer.
Right.
I've also heard it said as 1%, save 1%.
Okay. I feel like
the reason why you've heard both of them is because it differs on the loan size, right? 1% on 200,000 is one thing. 1% on 800,000 in California, totally different.
Yeah.
So 0.5% on 200,000, saving $1,000 a year of interest, maybe not.
Yeah.
0.5% on 800,000 is saving $4,000 a year, which might be $300 a month.
Totally.
So there's not really a real blanket answer because the loan sizes differ, right? So which goes back to talk to a consultant first. But my answer is that it depends on the break even. Okay.
Yay.
The right answer is you would choose to refinance, assuming it's not a necessity like a divorce or a death, or the need to go to a 30-year mortgage because life changed and you need to go from 15 to 30, right? So outside of necessity, you would opt to choose to refinance based on your break even. So a break even is really the easiest way to define it would be, what is the cost I'm going to incur associated with this new mortgage?
Mm-hmm.
And if I divide that by the payment savings, as an example, when you're dealing with just the rate term, if I divide that by the payment savings, how long do I have to stay in this property to pay myself back, right? Okay. So said a different way, if we just use a real easy number, 3% total closing cost, tax, insurance, everything, just call it 3%. Maybe it's $6,000 on a $200,000 situation, $9,000 on a $300,000. By the way, remember the higher the sales price and loan amount, the lower as a percentage the closing costs are, right? So between 5 and 10,000 is kind of a normal depending on what you're dealing with. But just use a $6,000 number. And let's say that in that example, the person was going to save $300 a month. Mm-hmm. Okay. Well, $6,000 divided by $300 a month is a 20-month break even. Okay. Which is less than 2 years.
2 years.
So the follow-up question I would ask if that was your scenario, I'd say, Bryn, do you plan to sell within 2 years? Yes or no?
Nope.
No. How long do you plan to keep the property for?
Several more years.
Okay. Minimum guaranteed.
Minimum guaranteed 5.
Okay, cool. So in that case, I'd say 100% you need to refinance. Okay. Because what that break even means is that you're just going to take those first, in that example, 20 months to pay yourself back, right? Because you're saving at the rate of the couple $100 a month, but you still already rolled in 6,000 more into your loan amount. But at 20 months, you've paid yourself back. So every additional month past that, for that next 3 years, 36 months, you're saving another $300 a month, $200 a month, whatever it is. So the longer you're there, the more it makes sense. But just don't sell or refinance within the break-even period that you did. Which goes to something that I'm super passionate about, which is it's not about the rate. It's not the rate, because the lower the rate is, the higher the fees are. Everyone needs to understand that as a basic thing. Is it's like a seesaw.
Once again, for the people in the back.
Interest rates and closing costs work like a seesaw. Higher rates, lower fees. Lower rates, higher fees. At the end of the day, you might qualify for 3.25. Doesn't mean you should do it. If you could take 375 and the break even is more in alignment with your goals, because the closing costs are lower and you for sure, well, remember my follow-up was for sure guaranteed what's the minimum you'll be there.
Right.
If you want to hedge for that, not for the best of times, the best case, but worst case, how long will we really be there? Well, my kid's not going to graduate for 5 more years. I'll be there for at least 5 years. Okay, cool. Now I've got something to, but I think I'll be there forever, right? If you're going to be there forever, for sure, do the lowest rate, even if the fees are higher, right? But I focus on refis with the break even. Why? Couple of things. Number one is you paid us at a closing cost when you bought the house. People forget that. Mm-hmm. On top of that, a lot of people pay in the higher fee, lower rate spectrum up front because rates have been so low for so long. So they don't think they're ever going to refi. And then what happens in the last 12 months? Another refi boom.
Right.
If you go back to January 2019, the average rate nationwide was a little bit over 5% for about 30 days.
I know.
Every single one of those people is refinancing right now. If they're smarter, their financial planners reached out to them, or their mortgage guy has, because when rates are under 4%, the situation changed. So they might have literally bought down. They might have spent extra closing costs to get down into the high 4s. So they spent that extra closing cost based on the break even at the time. So now you're agreeing to, and it does make sense in that case to refinance, but I'm always cognizant of, you already set a set of closing costs up front. Let's try to minimize the fees this time around if it makes sense, because we're kind of in uncharted territory, right? The stock market is literally at an all-time high right now. The rates are still crazy low, like almost all-time lows. That's economically not normal, right? So what is driving that? There's lots of things. I think
it's important to say, so we are in January of 2020. It's January 14th, 2020.
We're recording this. This will probably drop in February, I'm guessing. Yeah. So here we are in a year later, 2020, January, first quarter anyways. What's going on? we're picking, like, this is not a political conversation. I'm just saying there's a whole lot of uncertainty internationally, whole lot of uncertainty. So uncertainty in, it's an election year. Typically, there's a lot of fluctuation in the marketplaces in the election year. Who's going to win? Who's not going to win? Will the incumbent stay? Will a newbie show up? So you've got that going on. But internationally, I can just list a few off. Is Trump going to be impeached or not? Are we going to go into World War III with Iran or not? Looks like we're not, which is good news. Are we going to finally come to a final agreement with China on a new on a new tariff agreement? We've got steel issues with, I think, Argentina and Brazil right now. We have local homeland terrorism these days, right? Between all the gun issues. There's just a lot of crap going on locally. Now, at the end of the day, though, our GDP is unbelievable. We are actually making more raw materials as far as natural gas and gas. We are exporting more fossil fuels than we are importing for the first time ever. So those are all really good things.
Yeah.
So we're not reliant on the rest of the world. So all that is really good in general, which is why the stock market is at an all-time high, right? So, but typically what happens in normal economics is when the stock market goes up, bond market tends to go down, and rates tend to go up. Really easy.
Stock market up, bonds down, rates up.
Right. So if you think of it just that way only, and I'm trying to speak in layman terms. We can get into.
I don't
bond
really know
pricing.
how well you're doing at layman's terms, but keep on rocking.
I'll do my best. I'm not even getting into bond pricing because it's different to say bonds up, bond down. But it doesn't matter. In general, all this means is that when the stock market's really high, rates should be going up with them.
Should be okay.
Right. When inflation is increasing, which it has, rates should go up with the inflation. Right. On the flip side, the Fed is decreasing the federal funds rate. They did 3 times in the second half of 2019. So you've got these opposing forces that aren't normal economics. We're an emotional we're emotional investors these days as opposed to logical investors as a whole. Trump tweets something and people invest or divest from a specific stock based on something he says about Boeing or whatever. Yeah. So it's just, we're in uncharted territories. My point in saying that is, could rates go lower? Yes, they could. In fact, Fannie Mae and Freddie Mac both believe rates are going to be between 3.5 and 3.75 for 2020, which was not expected.
Really?
If you had said that in 2019, it just doesn't make sense, right?
So far away from what every single person predicted.
Yep.
And
myself included, you go back 2 years, I wouldn't have bet
the
that.
narrative has been
gonna go up.
Be prepared for 2020, make your plans. And especially, from a business standpoint, it's gonna be harder to close loans. So
and the truth of the matter is that the average consumer is bullish. There was a survey recently that more than 50% of Americans think that this year is a good year to buy houses. Interest rates are supposed to be under 4% for the duration of the year. Number 2. Number 3, there's a shortage of houses in most of the better metro areas. I'm in Texas. Texas has been on fire. You got in Florida is number 1, I think, right now. You've got Colorado and Nashville as well. Nashville, Colorado, and Tennessee.
Yeah.
All these areas are booming. And so what that means is that there's a shortage of supply of houses, which is good for the average homeowner for refinances because property values will go up. Supply and demand curve again. When there's more people wanting to buy houses than there are available in the market, you'll watch prices go up, which has been the story for the last 10 years anyways, since 2008. We sucked up the supply in 8, 9, and by 10, it was pretty much over. And all of a sudden we went into this seller's market instead of a buyer's market. So that's why we've got so many refis happening nationwide. Depending on the year, there's been some years that there's been more refinances than purchases in the mortgage world. It's kind of crazy.
This is really the first time I've ever been in the industry when this has occurred.
Yeah.
And again, going back to why I like refinances, it's an opportunity. I feel like it's just very much a win-win. You're not moving, you're utilizing your assets, it's cool. And then you can
what's really
use
cool
it to your
about
benefit.
And obviously, past performance is not indicative of future performance. I've been told that by every financial planner I've ever talked to. And it's true.
Yeah.
But when you think about real estate in general and you think about long-term, property values for sure have gone up. If you talk to a local resource, wherever you're at, a local realtor that knows what they're doing, there's a pretty good idea of what will happen with property values in your city. Just based on your local board of realtors, they can kind of tell you. There's reports. We're in San Antonio. There's San Antonio board of realtors, and we've got a housing forecast every January.
It was today.
It was today, literally, and there's a really good indication of what the next 3 years looks like. So here's kind of the split idea, but why this all ties into why somebody might utilize their property for a cash out or for a to pay or reallocation of debt, things like that. By the way, with the cash out, we didn't even say some people just take the cash out to fix up their property. Some people take out their cash to pay for college, right? That's a cash out refinance, or use it to reallocate debt. But my point is, San Antonio as a whole is probably appreciated on average about 6% a year for the last 10 years. Mm-hmm. There have been pockets that are not that good. There are pockets that are better than that. Geographically, things that are internal that there's no more lots to build on have outperformed because there's nowhere. If you want to live in Alamo Heights, you're going to pay a premium because there's no more lots available in Alamo Heights, right? Unless you tear down something. So my point about that is that let's just say the closing costs on average are about 3% to do a refinance. Well, if the houses have been appreciating at 6% a year, you could do your refinance and in 3 months' time, 6 months' time, potentially have already appreciated enough to pay for your own closing costs. Yeah. People don't think about that, right? If you're going to keep that house for 3 to 5 years, yes, there will probably be a housing downturn at some point in the next couple of years. But again, you can kind of predict that by just doing a little bit of research and talking to the right qualified people in your area. Locally in Texas and San Antonio for sure, we've been creating tons of jobs every year in every metro area. We've been working on our infrastructure. You've got a shortage of housing. So much so the builders are bullish and builders are putting more houses on the ground. Builders are a great way to pay attention, especially the nationals. They stop putting houses on the ground when they foresee a downturn, right? Or they at least slow down, especially after what happened in 2007, 8, 9. And so I'm just very I think it's a great time to buy real estate in general, or use it to, for your wealth and reallocation of debt.
Yeah, for sure. Okay. So, you're just so smart. That was just a ton of information. I love it.
I should touch on something because we're Military City, USA. There's a type of refinance that's important for veterans to know about.
Oh, good point. Yeah.
There's something called a streamlined refinance.
Oh, that's not what I was thinking. So,
there's something called a streamlined refinance, which veterans should definitely know about. What I like about them is that there's rules to protect the consumer. At the end of the day, it's that there's a math equation that we do to find out what the break even is based on the VA's definition of break evens, right? So there's got to be a certain amount of savings with a certain amount of cost maximum based on the loan amount. But
it has to be a certain amount of savings.
There's got to be a specific savings
as far as
a percentage. So the easiest way to say it is the new streamlined rules do a better job of protecting veterans from usury, protecting veterans from the bad loan officers in the world. Because for sure, I think that they were the most ripe for predatory lending a couple of years back. Because here's the benefit of a streamline: you don't have to requalify, as long as there's enough payment savings based on the VA's term.
Savings.
As long as there's enough savings,
gotcha.
Then you literally do not have to reprovide your paychecks, bank statements, W-2s, tax returns, nothing. You don't have to get an appraisal in some cases.
I am totally learning right now. I did not know this.
As long as the loan amount doesn't go up, you don't even have to get an appraisal. So
I'm a veteran.
You're a veteran. You've been in your house for 5 years. Again, closing costs, assume that it's within that range the VA defines is okay. You could literally find out, oh my God, I can save $200 a month. Yes, I'd like that, please. And basically be done within 2 weeks on a streamlined refinance because you don't need anything to qualify. It's something that the VA does to take care of veterans, which I really love. There's instances we don't even have to deal with. Like, there's no qualifying criteria to do a streamlined refinance.
My mind can't even wrap around this. I'm like,
it's because
so we pull their Well, no, because
we don't do much of anything. I hate to say it that way. Loan officers don't do a whole lot with the Streamline. It's basically send in your mortgage statement. Yes, we have to re-pull your information as far as name, socials, dates of birth, all that stuff.
All right. So we're going to pull
You certainly can't be late on your mortgage. So that would be a
no
criteria.
late.
You can't be missing mortgage payments. But outside of that, yes, please may have another, and you can do it for veterans all the time, which is why that was ripe for predatory lending.
Right.
Because people were rolling in. I literally had a client of mine that we closed at what the rate should have been. And then 3 or 4 months later, you got to understand that these are things to watch out for, by the way. We don't sell, nor does any mortgage company have the right to sell information about their clients. But public information is public information, like when a deed is filed at the courthouse. A deed of trust is filed at the courthouse. So there's people that literally go and buy the public records and sell those. So so they go down the public, they find out on January 1st that these 400 people closed on their new property, and and some of these were VA loans, some of these were conventional or whatever. Well, they scrape all the VA loans. They then send it to these VA Streamline lending companies. Those people then rotodial and try to call people and say, hey, veteran, you don't have to do anything. You qualify for a point lower rate. Well, what I say earlier, higher rate, lower fees, lower rate, higher fees. So this specific veteran ended up rolling in literally 3 points into his loan on top of normal closing costs.
Oh my gosh.
3 months after we did their loan. And the rotodialer called and basically represented them as an extension of us. It had nothing to do with us. Yes.
Wow.
So that happens. So my point is that if you are listening and you get contacted by somebody you don't know, this is when you would reach back out to the person that you trusted, that your realtors trust, or make sure it's the bank source that you believe in. Don't just take that rotodial because that's what they do.
Because it's either, really, that information should come from the person who funded your loan and then the servicing person.
The servicing is the most likely because they've got the bandwidth to keep on calling their past clients.
And by that, so by servicing, like after we fund our loans, we will sell them to the big guys, the Chases, Bank of America's.
Yeah, it's all different. So every bank's a little different. Some banks will hold the notes. Some banks will transfer the notes. Bottom line is, whoever your mortgage statement from is the servicer. That's what mortgage statement says at the top, Mr. Cooper. That's your servicer. If it says Bank of America, that's your servicer. So your servicer most of the time is going to be contacting you because they've got literally warehouses full of people cold calling all the past clients to try and churn them. Why? Because they probably paid money to buy that note receivable. The mortgage is considered a note receivable. It's important for them to keep those notes on the books. So they'd rather refinance and keep them there than let them go somewhere else.
I also think that's where people or consumers get confused on who to listen to, because these the larger banks, the larger companies they have a department that is their job to call through and say, hey, it's a good time to refinance. Well, then, so they're getting those calls on the regular. Then we do our due diligence.
Or people like us,
and we'll call and say, hey, now it's a really good time. And how do you really know when it is? Like, when is it a sales pitch? Or
goes back to finding a trusted resource is always the first answer. Second answer though is that is it worth listening? Yes, I think it's worth listening. I think that you don't know what you don't know. And the reason why I say that out loud is that yesterday I refinanced a guy, one of my past clients that I've mailed to and called and sent to video emails and given mortgage market outlooks and done forecasting for and invited past client appreciation parties. And he still hadn't refinanced since 2013.
Like, it's a good time. I didn't know.
Oh, yeah. That means 15, 16, 17, 18, 19, all those times. And now it's 2020.
It's like all about all in good time. All in good time.
Right. So you don't know what you don't know. Most people, it's just a burden. I mean, at the end of the day, yes, mortgage companies take your firstborn child, a blood sample and a stool sample, right? So that's never fun. But, this whole thing that we're doing is about money sense, right? It's about, what should you be paying attention to? So if you're getting addicted to your monthly budgeting, what ends up happening inevitably, it happened to you actually, because I remember this. What ends up happening inevitably is, okay, well, I cut my cord with the cable company. Okay, I renegotiated my cell phone bill. Okay, I cut up my credit cards and I only have $1,000 credit card that I use for gas. And you keep looking at your budget, and your goal, remember, is always to increase your savings by $1 or decrease your debt by $1. And some of you that are listening have no debt. You have paid for cars, no credit cards. There's only one thing staring back at you as a fixed monthly expense outside of, you got food, food insurance, tax, things like that. Right. It's your mortgage. So at some point, you got to look at what's typically on everyone's balance sheet, their biggest line item. It's their mortgage. So I can go back and screw around with saving $20, $50 here and there with all this other little stuff. Or once a year at least, I can relook at my mortgage and figure out, okay, does it make sense? Not I'm going to do it. Does it make sense to do the math? And if the math says, yes, you should, I don't care how busy you are. The math says you should. So do it.
And really and truly, I mean, so
that's what I love about refis is it's just a math thing.
It's just a math thing. Absolutely. And so I think, with our refinance, it was an opportunity. We had finally decided we're not going to move. We toyed with that for a little bit, finally decided that wasn't the case. And rates were going low. I finally started paying attention, right? I'm in the business. It's like, okay, now I need to look at my own stuff. And then you look at, okay, well, here's all the options that you have available to you, and which one makes the most financial sense to do. And if you're going to be there for a while, well, let's take some of that money and reinvest it back into the house. So that way it can have a little extra boost in appreciation. So in the 5, 7, however many years, well, now we're just in a better position from an appreciation standpoint when we go to sell.
Yep. Well, also what it's really funny that you said that. So my last house that we left before we moved into my house currently, we always talked about we're going to redo the kitchen and redo the countertops and that stuff. We always talked about it. When we did it? The month before we left.
And then you're like, why? This place is great. Why should we move?
Yeah, exactly right. It's like, why didn't we do this 5 years ago so we could enjoy it?
I mean, when you get your house show ready,
right?
It's like,
this place is pretty cool.
That is very true. Okay, so let's talk about, first, I want to finish up the thought process around the VA refinances. What is the difference? So you talked about a streamline. What about an IRL?
That's exactly what it is.
It's the same thing?
It's an interest rate reduction loan.
Okay, so that is the same. Yeah. So either streamline
there is a VA refinance that is not an IRL, right? So it's just, do you need to qualify or not? And do you need an appraisal or not, right? The appraisal comes in if you're going to increase your loan balance off your original loan amount, meaning you had a starting loan balance of $230 and you're refinancing pretty quickly. So remind you, most veterans have they have their loan amount, they're rolling in their funding fee, so their loan balance is actually higher than their purchase price day one.
Okay.
So most of the time, if you're refinancing too close to the purchase, you're by the time you're rolling closing costs, if you don't pay them out of pocket, you end up with a higher loan amount than what you started with.
Yeah.
Which may or may not make sense, but if it's going to go up, you have to get a new appraisal. Okay. Now, if you're 5 years in, presumably let's stop right
there for a second. So if you're starting in that scenario, your loan amount is higher than
your starting
loan amount because of rolling in and financing your funding fee. Then you get an appraisal done and it's the same.
Very similar. Yeah. It's more, that'll be more the technical
same amount.
side.
It's the same amount. So it appraises for the exact same amount.
Yeah, so you can't have a loan amount greater than your appraised value.
So there's no cash out.
No, if you are trying to roll in closing costs above 100%, you can't do that at this time.
Okay. And then what about if it appraises by like $2,000?
You roll in $2,000 more.
Okay, so
a portion of the closing costs in that case.
Okay.
If you need an appraisal. But the beautiful thing is, like I said, if you are a couple $1,000s less and you're doing an interest rate reduction loan where you don't need to qualify, we don't need an appraisal at all. So you can roll in all closing costs into it, not look at the information at all for qualifying purposes, and just be done.
Okay.
So it's way, again, there's very strict guidelines on how much you can roll in, what the break even is. Does it make sense from the veteran's perspective the VA's perspective for the veteran to do it? If it fits those parameters, they reduce everything, which makes it a very cheap investment, very cost effective, and very easy to do, right? Okay. Which brings up another point, because in general, you need to understand, what's required to refinance in the first place. Well, you can increase your loan amount on every other loan type over what you started with in some cases, right? So a conventional loan, you might have started with 20% down. But you can actually go to so that'd be 80% loan to value.
Okay.
20% down. You can go to 85. So you could, in theory, roll in your closing costs, go above the 80%.
So use real numbers and walk through this scenario.
So you have again $200,000 sales price, 20% down when you bought it. So you've got a 160 starting loan amount. Rates plummet in the first year, like this last year happened. So it does make sense to refinance. But you don't have cash to pay closing costs. So you do want to roll the closing costs in. Well, instead of being at a 160 loan amount, you end up at a 165 loan amount.
Okay.
Well, you still have equity.
$5,000 comes from your closing costs.
Yeah, or whatever the difference is, and you roll it in. So you're over 80%, but you still have equity in the property. For a conventional loan, you need 3% only. So if it's as long as you have 97% loan to value or better, you can do it. You'd have to price it differently. We'd have to look at mortgage insurance possibly, but can you do it?
So you
yes.
get an appraisal.
Yeah, get an appraisal.
See what the value comes in at. But again, this has only been this is in this scenario, it's a short time frame, right?
A year, yeah.
About a year.
Yeah, so my point is that you don't, just because been a year doesn't mean you don't have options. For FHA loans, typically, most of them you do 3.5% down, but some people put down 5 or 10%. So again, in those scenarios, you could potentially very quickly still be able to roll in closing costs. Now, another thing to keep in mind is you're basing, every bank's a little bit different, but for the most part, if you're a year into your mortgage or greater, the sales price doesn't matter anymore. The loan amount doesn't matter anymore. The appraisal does. So let's just say you bought the house right. Okay. Let's say that you put down 10% initially. That's all you had it was worth $300,000 when you bought it.
Okay.
But you bought it for $250,000. Okay.
Okay.
But you had $25,000 to put down. So you had $25,000 down. So you had $225,000 loan amount. Okay. So you were priced on, and you have mortgage insurance based on a 10% down conventional loan or a 10% down FHA loan. Okay.
On a $225,000 loan amount.
$250,000 sales price, $225,000 loan amount. Yep.
But it's worth $300,000.
But it's worth $300,000. When you go a year into it, now the sales price doesn't matter. You bought it right. It's worth $300,000. Okay. So now we get an appraised value at $300,000. Well, 20% down on $300,000 is $60,000. Okay. So 300 minus 60 is a $240,000 loan amount. You're already below $240,000. You're at $225,000.
Oh, wow.
So now I can give you pricing, better rates, better fees at a over 20% down loan, get rid of mortgage insurance. The rate could literally be the same and the payment would go down. Right? So
that's some real fancy footwork, Sigman.
Well, it's weird stuff that's in my head, but when you think about
what's
payment,
cool about it.
When you think about payment savings, it's not just the rate, right? The rate matters.
That should be the slogan.
So this goes back to
not just about the rate.
We're talking about the rule of thumb is drop at half point. No, that doesn't matter. Yeah. It does matter in some cases, right? But the term, right? If you went from a 20-year to a 30-year term, your rate would go up, but the potential for the payment go down is real.
Oh yeah, we went down too. We also went down. I always forget about that.
Right. The other one would be getting rid of mortgage insurance. So a lot of people will, the biggest hurdle to getting a home these days is the down payment. So most people do the minimum down, 3, 5, 10, 5% down, whatever the minimum is for whatever loan type they're doing, 0 for a VA loan.
And you have to have 20% down for a conventional loan, right, Josh?
No. Yeah.
I just feel like we should plant that
all the time as well. 3% down for conventional loan is the minimum. So my point though is that somebody puts in their minimum investment, they bought it right, or they wait 3 or 4 or 5 years. Well, usually, depending on the loan type, if you do less than 20% down, you have that mortgage insurance, right? So let's say that 3 years into this, your house, you're in a highly appreciating area. You get the value of that appreciation through the appraisal. So again, same thing. I went from 250 to 300 or 250 to 400,000 value. My loan amount, my loan to value is less than 80% in the refi. I could literally have a little bit higher rate in the refinance and still drop the payment by getting rid of the mortgage insurance. Right. And when you look at the bill and you see that $250 mortgage insurance, it's frustrating.
That is a chunk of money.
Because it doesn't protect you. It protects it insures the lender against your foreclosure. So you're paying for their insurance. So get rid of that crap if you can.
So, yeah.
right?
Okay.
But those are all the things that come into a good consultation on a refi. And here's where, let me just say this, this is not self-serving. This is just the truth, right? The iBuyer, the internet consultation, the I can do a mortgage with the click of a button thing.
Yeah.
Don't do that crap when you're doing a refi.
Oh, I love.
Don't do that crap.
Yes, good point.
There are so many different ways to structure it that could be more advantageous for you. Yeah, it's easy to push a button. I get that crap. But the truth is that this, especially a refinance, would be where you need strategy and math and a consultant to tell you
strategy and purpose.
Yeah, to actually accomplish a better ending, right?
Yeah.
Because the rate looks good. I'm in a refinance. Cool. You just cost yourself 10 grand and you're going to sell in 3 years and you break even in 5 years. That was not smart. You feel better because you got the best rate, but it doesn't help you.
So there's another scenario I want to share that I just thought was incredible as far as like creativity and really using your assets to your advantage. And we had a client over, I don't know, probably midway through 2018, and his primary residence, great rate, good there. And this, let me back up. This conversation started from me, just shouting from the rooftops, like, hey, friends, family, loved ones, Facebook, everybody, it's time to take a look because you just don't know what's out there. Well, so his primary residence is fine. Then he had 2 investment properties with both had mortgages on them. We cash out refinanced one of his investment properties and use that cash to pay off the other one.
Yeah, so it was really interesting because the mortgages, the cash flow, all we were looking at was the cash flow, right? So the 2 mortgages were, call it close to 40% loan to values. So he had a great equity stake in both of them. Actually, I did this with one of our realtors too recently. And all we did was we did a cash out refi on the one. So it took it from, so it must have been even less than 40. It was probably 30 and 30 or 30 and 35%. Because one rule to know, just a basic couple rules to know. In Texas, as an example, you can't take out more than 20% equity on a primary residence. So, 80% loan to value is the max. But investment property cash outs are typically limited to 75% loan to value. Okay?
I was going to say, we
so there is a limitation,
about,
right? So whereas on a purchase, you do a down payment of 3, 5, 7, 10% or 0 for VA. Just
really quick. So the max you can take out on a primary residence.
The highest loan amount is 80% loan to value.
80% loan to value.
So there's not a max you take out in cash. You can take out $500,000 if you got it. But it's 80% of the appraisal is the max you can take out, less your appraised value, less your payoff, less your closing costs.
Okay.
So for easy numbers, $1 million, you have a $500,000 loan. You can take out $800,000 total loan amount minus the $500,000 that is your current payoff. You got $300,000 of equity minus your closing cost, 10 grand, right? So you get about $290,000. You get a $290,000 check in that case.
And that's the max. And what I learned through our personal refinance was
other states are different, guys. Texas is specific though. There's a Texas A6 law. There are some states that allow you to do more than 8%, but for sure in Texas, you can't take out more than 80 on a primary.
Is that you don't have to take out that entire amount. Like you literally can choose pretty much. Like here's your max.
Oh yeah, you can take out 100 and be done.
And so
and I would encourage, like if you don't have a good use for the money or you know where you're going to put it, don't go take out 200,000, put it in a checking account at 0.02 and have a rate of 4. That doesn't make sense, right?
And because it affects your monthly payment. So you really want to have those conversations of what are the plans?
What am I doing with this cash?
What are you going to do with
the
it?
Equity?
And then what a new mortgage payment fits into your budget. So I think that's...
And this goes back to finishing up that your friend. So the specific investment that we had 75% loan to value. So both of them added up to less than 75% loan to value. So all I did is do one loan on one property max. The other one is now free and clear. Because it's free and clear, that entire rent check comes into them.
Yeah.
Plus, they're still getting a little bit of cash flow on the maxed out mortgage.
Yeah.
Combined, it was like a $450 better cash flow for them just by combining.
So, I mean, I love that. I just love scenarios.
That was a cool deal. I enjoyed that one.
So fun. I love those conversations.
So I hope what everyone's hearing is I started by saying, well, there's 3 types of refis. Well, there's 4 types of refis. Well, there's 5. There's so many scenarios that just keep popping in my mind. I gave the basic ones.
Here's how I see, especially you working with refinances and really any type of mortgage, is a glass wall with all like the little numbers all over it. And you just like move them all around.
Have you seen The Beautiful Mind?
Yes.
All I do is I see weird numbers on a wall and they kind of move around and all of a sudden they disappear and it works for me. That's how it works for me. I'm not a beautiful mind, by the way. That was not but that's how I think as far as numbers.
Sure, Josh. Okay.
Trust
Look,
me.
we've already talked about how great you are this entire podcast.
Ask Christy how great I am, and my wife will say you straight. Are you in trouble? I'm always in trouble. She's awesome. She's usually right too. I just hate to admit that.
Of course she is. Of course. What
did we miss?
I don't know. I got sidetracked on wondering what. No, I'm just kidding. Okay, so a couple of things. What happened? So I think that an important thing to understand is that a refinance it's a new mortgage. It is a closing. You will go to closing.
Yep. It's a restructure.
It's a restructure. And that means, there's escrow accounts involved. And so what happens? That's
a great thing. So there's a couple of secondary and tertiary benefits that people actually use to their advantage, right? So first thing that happens is, let's just say that it's January 2020. You want to refinance. Normal time frame for us is 21 days. National average probably 45 days, depending on the bank size. Bottom line is you're going to probably close in February. If you loan up in January, you close in February. Okay. Well, when in February matters. When in the month, because if your payoff, the refinance will pay off the old mortgage, can serve as a payment. Okay. So what that means is on a conventional loan or a VA loan, not FHA for a specific reason I'll explain in a second, if you close before the 15th, you don't have to make a mortgage payment in February.
That's what happened to us. We had literally
almost 3 months.
The best scenario of cashing out.
So you don't have a payment in February. You skip your March payment altogether because there has to be interest accrued in order to have a principal and interest payment. Mm-hmm. Your first payment would be due April 1st, late April 15th, before there's any late charges. So literally you could close on February the 10th and not have a payment until April 15th. So over 60 days,
cha-ching,
right?
Cha-ching, cha-ching.
So that's one benefit, which when you think about it, that helps offset some of your closing costs, right? Because you're not using money over here. So if you can steal from, you feel tight on your savings account, but I can part with $5,000 knowing that I'm going to not have to make these two payments,
right?
Then you can kind of better your scenario there.
Do you feel like, sorry to interrupt, but do you feel like most people roll in their closing costs when they're refinancing?
Most people do. It's not always possible. So at the cost of $4 per $1,000 finance, 18 years to break even, by the way, roll in your closing costs if you can.
Okay.
But it also can be the difference of, if it's a $7,000, loan amount difference, that's $28 a month ish. And that might be the difference in your break even of making sense or not, in which case bring your cash, right? Okay. If you've got the cash, think about it. If you've got your $15,000 sitting in your savings account, it's been there for 6 months and you haven't done crap with it. Yeah. Use $7,000 out of that to save yourself $20 a month. It's better than sitting in the bank account, right? But that's one benefit is you miss a payment or two. Okay. Now that does not work on FHA loans. FHA loans, part of the payoff is you whatever day of the month you close, you're paying the entire months of interest. So if you close on the 1st of February, you're still paying 30 days of interest in the payoff. So the point is that you're effectively making the payment in February anyways. That's just for an FHA loan.
But you always, on a purchase or a refinance, you always skip a month. Whatever month you close in, you skip the following month, and then that is your first payment's due.
A secondary thing that can be used as a benefit, some people think about is a refund of escrow accounts. So it's worth talking about escrow accounts in general right now.
It really is.
An escrow account is the separate account that's part of your mortgage payment. Especially if you do less than 20% down, includes tax and insurance and mortgage insurance. Okay. So when you make your $2,000 payment, you might have $500 that's tax, insurance, and mortgage insurance. That's siphoned off into this separate account that is held by that servicing entity on your behalf that will serve as the funds available to pay the tax bill or the insurance bill as they come due. Okay. So that's your money. So when you sell a house or if you refinance your property, that escrow account is closed and it must be refunded to you within 45 days. So now you're missing a payment. You're going to get a check back for whatever literally is in that escrow balance.
Yeah.
So when you look at your you're in June doing a refi, you have 6 or 7 months of property taxes or insurance, which can be significant, right? Another benefit or something that some people choose to do when they refinance is if they've gone from a 10% loan to value and now they have more than 10% equity to more than 20% equity, that client now has a choice to service their own escrows, meaning that they don't have to have an escrow account at all. And then they just pay the tax bill on their own at the end of the year and the insurance bill as it comes due. The reason why people might do that is to earn interest on that money. Okay. If it's a $2,000 a year of tax and insurance, don't bother with it because it's just a pain in the butt. But there are people that have $20,000 of property taxes. Yeah. Hold on to that money. Be responsible, set it aside in a separate account, earn interest on it. And then pay the tax bill at the end of the year, right? But the benefit again would be if there's enough equity, you can roll in setting up the new escrow account and you're going to get a refund of the old escrow account. It's going to be a wash. That's not a cost, that's a wash. What you do with that refund of escrow is up to you. Some people will just say, I don't want my new higher loan amount. So they just mail that back in with their first payment to reduce the loan amount back to where it was a wash.
Oh, okay.
What some people will do is they say, well, crap, I just got $5,000. I've got this $5,000 credit card bill. Let's just pay that off.
Yeah.
And some people aren't the wisest with it. They'll go to Disney World.
Go to Vegas, baby.
Yeah, which is
That's what we did.
Exactly. You are bright, but
luckily we hit the jackpot.
Right.
All on red.
You put it on red? Awesome.
Yeah.
So
kidding,
that's another thing
totally
that happens
kidding.
when you do a refinance, right? Is the escrows. What else is
Okay, so your escrow accounts gets refunded back to you.
Payment, yep.
And what about insurance? So
when you sell a house, you always prepay insurance up front and you pay in arrears whatever the property tax bill is. Okay. So all that means that you seem super frustrated that you don't have.
I know. Oh, yes.
There's more. Good.
There's more.
The world has not come to an end. Jesus.
In the world.
So my point is that on insurance, let's just say you bought a house today and you sold it or refinanced it in a month. Well, the day you closed on that property, you paid 12 months of insurance. People forget all the time when they sell their house to notify their insurance provider that they sold the house because they would owe them 11 months back.
Ooh.
They prepaid. It happens all the time, guys. Pay attention. So
you always prepay.
Everyone's required. Why? And understanding the why is important. The insurance protects the collateral. The collateral is the building. If the house burns down, they need the collateral to be rebuilt because that's the collateral, right? So that's why you have to always prepay insurance. If you buy it today, it burns down tomorrow and there's no insurance, there's a problem with that $500,000 loan, right? Separate of the emotional damage with the family, right? But banks aren't emotional about it. They need the collateral protected. So my point is on when you're doing the refi, same thing. It's a great time to shop your insurance provider.
Right.
Because most insurance agents, I've had some great ones I work with that aren't these people, but
we really do.
Most insurance companies, when they lock you in, they tend to raise your rates over time. Mm-hmm. They certainly don't shop around to find out a better rate on the annual anniversary. So if you're going to do a refinance, it's going to affect your payment in cash anyways. Shop around, find out if there's a better option with the same coverage or better with the lower payment.
Right.
And that would be a time to set it up.
And so if you, in that scenario, you're refinancing, you do shop and find somebody different, a new insurance agent to go with or insurance company. What's that?
So company A is who the current insurance provider is. Company B decide to go with. I would take that information, close the loan, have the new payment set up, prepay the first year of insurance with a new provider.
Which happens at closing.
And there might be a right of rescission. Like Texas, there's a 3-day right of rescission. So it might be 4 days after closing. Okay. Once it's funded, the key word is funded. Funded means the parties have signed.
Money's in the bank,
money's been transferred. Okay. By the bank to the title company, money's been transferred. At that time, then you would cancel your old insurance company.
And so you just call them up.
You call them up. Hey, I'm canceling my policy. Refund me my insurance too. Insurance is strict
throughout the year, right?
Well, so it's just a proration. It's a proration. Right. So if you're 1/12 of the way through, you have 11 months owed to you. If you're halfway through the year, they owe you half the year. It's just, they're very strict laws with insurance that it's what's been used. They can't just juice you and keep the extra cash.
And so when you get that money
In fact, by the way, you can call months later and say, by the way, I sold this house back in May and it's November. Send them documentation proof you don't own that property anymore. They still have to refund you that difference. There was nothing that was insured at that time.
Gotcha. Okay. So you're saying in the instance that you forgot to cancel your
policy. Or you
policy,
heard this and you're like, I need to do that. Yeah, you can call them.
Well, but wait. So if you forget to cancel the policy, well, they're not being paid though, right?
They were paid in advance.
Oh, that's right. Okay.
They were paid in advance. They've got your money, girl.
That's right. Okay.
So it's your job to go begin to refund.
So you have to notify your insurance agent that they are.
Otherwise, what they'll do is they'll use the entire year. You never notified them. They just won't get a check for the next year. So then you're uninsured the next year, but you might have been insured for 6 or 8 months too long. So you just wasted money.
Okay. And so when you get that refund check, so you do your due diligence, you call your insurance agent, say, I have switched companies. When you get that check or that refund, is it yours or do you need to put it in? You
can do whatever you want.
Okay. So
you
that
can
is your money.
reapply it back towards your, reducing the loan balance. If you rolled it in, you could take the cash and do something better with it. Just don't go do the bad things with bad people.
Don't hang out with you. Ha.
Obviously. At least me in my 20s. I'm pretty good now.
Okay. So now that everybody should be convinced that they should refinance.
If it makes sense, yes.
After sitting down with,
at least
with
investigate
the Sigman team.
once a year. At least investigate it once a year.
And so what does investigating look like? Just to kind of wrap this up.
My team makes it easy. Every company's a little different. All I need is a copy of if it's a past client, a copy of their mortgage statement and permission to repull credit, and I'll look at it. Takes 24 hours to give you a straight answer.
And if we don't want to repull credit, is there anything?
Well, then it's suppose, right?
You're assuming that their credit is good.
We gotta assume they've got perfect credit and great debt ratios and the appraisal's fine. You can get closer, but it's not the wisest way to do it. If you're gonna make a decision, pull the credit, look at real numbers, and then do the math.
But by looking at a mortgage statement.
Yeah, it just shows me what the payoff.
And you're assuming everything else is good. Look at the mortgage statement. We should be able to say, it looks like there's some opportunity. Let's take the next step.
Yep, that would be one. And then if they're considering reallocating debt, restructuring your debt with cash outs. If you're thinking about rehabbing a property or taking cash out to pay for college, things like that, then those are consultation meetings, right?
Yeah, absolutely.
Weigh the pros and cons, come in the office or meet with your provider, meet with them face to face, look them in the eyeballs, make sure they know what the hell they're saying. Because, you might evaluate, what could I get my student loan rates for? What's the monthly payment going to be on a student loan versus taking it out of my mortgage, right?
Yeah.
Do I really love my kid that much? Like, am I take the student loans out and they're going to be doctors, or am I take the student loans out and they're going to fail out? Right. So,
right.
But there's evaluation questions around that.
The other thing too that, I know we try to be very diligent about this is when we do a pre-qualification for somebody that's looking to purchase a home, looking at their real estate owned for them proactively and trying to identify opportunities that, they maybe didn't call about. And so it's not from an upsell position. It's from a, I'll give you a perfect example. I remember in December, this exact thing happened. The person sold a property. So again, this gets into, I'm not a CPA, I'm not giving you tax advice, but I'll tell you that one of the tax laws that changed was if you live in a primary residence for more than 2 of the previous 5 years, so you could have moved out and it could be a rental property for 2 or 3 years. If you occupy the property as your primary residence for 2 of the previous 5 years, up to a limit, I think it's $250,000, it's a tax-free sale. So any gains on that house that you sold, you bought the house for $200,000, you sold it for $400,000, you lived in it for the last 5 years, that $200,000 appreciation is 100% tax-free based on current tax law, the way I understand it. Talk to your CPA about it, okay? Wow.
So I don't know a whole lot of tax-free events, but that's a good one. So This person sold their house. They're saying $200,000. They said, well, I think I just want to put it all into my next house I'm buying. And I was looking at the REO. Well, primary rates,
which is real estate
owned. It's part of the loan application, the standard uniform residential loan application. My point is that they wanted to put $200,000 down in a new house. I want to say it was a $500,000 house. So they're going to have a $300,000 mortgage. Rates are in the 3s. They have when I was looking at REO, I saw that they have an investment property. The rate was $575. So I told them, nope, you're not going to put down $200,000 on this down payment. You're going to do 20% down, right? So you're putting $100,000 down on the 500,000 and taking the other 100,000 and paying off the rest of this investment property, which is at 5.75.
Yeah.
So is the monthly payment higher on your primary? Yes. But your cash flow is better. And I traded a 5.75 rate against a 3 and a 3.75 rate in that example. Yeah. And so, I love that you said that, because again, good mortgage companies will not look at the request. And here's a big bug in my butt that just drives me nuts. The average mortgage experience is an order taker experience, meaning most loan officers are no longer licensed. If a loan officer works for a nationally chartered bank, they're not legally required to be anymore, right?
And so what that I like to paint this picture. Right. That means that a bank teller decide,
a bank teller could be the head underwriter and then the head loan officer in a matter of a couple of years with very little or no real background or knowledge.
And there's no continuing education.
Very little. I mean, it's as much as or as little as the company provides.
Yeah.
Point is that you got to question what the advice is from the source, right? So I believe if you're going to get a mortgage, go to a mortgage company that only does mortgages. They're probably better suited than some company that does mortgage and banking and insurance and
we're one trick pony. We have to make it work. We have to know what we're doing.
Figure it all out, right? Exactly right. And so I think that's a very valid point. It's just the truth of the matter is if you're not dealing with a consultant and you're not getting that in-depth experience, this goes back to kind of summing up my thoughts. The average experience in the click a button is I want this low rate because my daddy told me so, or because I watched the internet and the banner said rates are lows, or I watched the TV and the commercial said, use us, we're the cheapest, easiest, and best in the market, right? And so the problem with that is the average consumer knows enough to be dangerous, but it's kind of like, why do most people use financial planners? Because the financial planners look at the market every single day.
Every day.
I'm sure you can day trade. But if you've got a day job, you're not day trading every minute of every day. Let the professionals do the work, right? Yeah. And so when it comes to buying a house or refinancing, I personally believe get a professional. It's only the biggest investment of most people's lives.
Yeah, totally.
So don't wing it and say, I know it's get no points, lowest rate. Okay, maybe.
That just terrifies me.
Maybe not. We'll find out. Let me talk to you first, right?
Absolutely.
So,
all right, cool. So here's what I'm hearing to put this to bed. One, let the professionals market to you. So if you work with a great mortgage company or a great team like the Sigman team, we're going to market to you. We are going to follow up with you. Yep. You're going to get postcards. You're going to get calls. You're going to get videos. Don't unblock it. Don't think it's spam. It's us it's our way of
informing you
and keeping you not
knowledge is power.
It is power, and letting the sooner you know about anything, the more opportunities you have. And so let people market to you. The second thing is what I am hearing is, holy moly, it is good to look. It is good to just kind of take a peek, because you, like you said, you just listed off so many different scenarios, and chances are like there's maybe something really advantageous within your mortgage that we can play with. So I love it. I think it was awesome. Hope you're enjoying this podcast for all of our listeners, and make sure you like us, make sure you subscribe to our channel, and comment and tell us what you think and any extra topics that you want to hear about.
Anything money, I'd love to help you out.
Money talks. Boom.
Take care, guys. Bye-bye.
Bye.